Hello, everyone. Welcome to lunch. I can have your attention for a few minutes. Remember, we'll go back upstairs for the autonomous cars panel, and after that, we head out to Waterworks. And we've been getting a lot of questions. There's a couple options. We have shuttles. We can get you there. If you have your car and you'd like to drive, that's great. There's plenty of parking available for you. Go down to the George Flag entrance, which is not the first one, but it's the second road. And there'll be balloons, plenty of markings. You'll be fine. Just follow the rules. So let's see what else. It is a little chilly, but the sun is going to come out. It is. And we do also have tents and with risk management, we also have warmers, heaters, keep us warm, because we've got plenty of beer and food trucks and cars to explore. So I believe that was everything. Oh, we also have a shuttle to the airport. If you're needing that, we've provided that. Apparently the taxi situation, there's not enough revenue stream there, so we will cover that for you if you need it. And enjoy the rest of the day, and I'll bring up Doug Oman at this point.
I know you are enjoying your lunch, but I now have the good pleasure of introducing to you our luncheon keynote speaker. Bob Kerzner is an individual who has appeared at numerous events. He's a leader in the space of retirement products, life, and annuities, and an individual who's very knowledgeable. He's sought out by many publications, the Wall Street Journal, Bloomberg News, etc., to share with many folks his wisdom in these particular areas. Bob is currently serving as president and CEO of LIMRA LOMA, an organization which I know many of you are familiar with. It's a professional organization involved in education, and we are very, very happy to have with us Mr. Bob Kerzner.
Thank you. I can't get there. Thank you very much.
Thank you for being here.
Well, good afternoon. I'm sorry to interrupt your lunch, and I hope I won't give you indigestion. But what I am going to do, as soon as we bring up my slides for me, is I do want to talk to you a little bit about what are some of the trends in the life and the retirement business. And let's start with life insurance ownership. How are we doing? Every 6 years, we do a study to really dig deep into life insurance ownership. And it's kind of a mixed story this time. In fact, we're up in the number of households, but we're actually still not back to where we were back in 2004. So we lost a lot of ground. But bear in mind that the population is growing. So in fact, even though we're doing a little better, we're still losing ground. How much ground? Well, if you really look way back into the 1960s, in fact, 83% of households owned life insurance. And that number, as you can see from the red, has come down. And so it's not a good trend. The good news is we're holding flat now. We're not going down more. But the really disturbing one is the blue line. That's individual life. And as many as 83% owned life insurance as households back in the 60s, and that's down to 44%. So we're seeing a really significant difference. Now, during part of that period, if you can see the green line, in fact, that shot up. That was group insurance. But even that's starting to decline. So it's really not a good trend, and one we need to be thoughtful about. I guess when you really think about it, though, more households, oddly enough, tell us they plan on buying life insurance. And this was an anomaly in this year's numbers. 6 years ago, a lot more people said, I need it, than they did this time, but more people said, I'm really going to do something about it. By the way, very few of them actually do, but you know the road to hell is paved with good intentions. But yet our folks feel that from our data, 48% of all U.S. households have a gap. And in fact, that gap is $12 trillion. And so that's a great opportunity for the industry. And what we're going to talk about is, what is it going to take to get to more of that? What's it going to take to get people to save more money for retirement? There was a little good news, and that was on the front with millennials. Because with millennials, what we did see, now that they're having children, now that they're starting to form real households, they in fact are buying life insurance. And we saw a 43% increase in the number of millennial households that had life insurance. So I used to get asked 5 years ago by the press, are we ever going to be able to sell millennials insurance? And I said, absolutely, but you've got to remember, they're 5 to 7 years behind having children, buying homes compared to boomers. It's just going to take time. And in fact, what we do see is it's beginning to happen. Really, I know this one's going to be hard for many of you to see this slide, but really what this slide talks about is a tremendous change in what kinds of life insurance are being bought. When you look back at 2005, about 17% of all policies were cash value oriented. Now we've seen a complete shift. A lot of this is because of the downturn, low interest rates, but we're seeing 46% have cash value as an important feature. Now, previously, we might have been selling universal life, which in theory had cash value, but these numbers take out those that were bought with very little as more of a death benefit product. But certainly, when we look at middle-income American households, they heavily want cash value because they really don't like the idea of putting money in for term and seeing no return. Annuity sales really were flat for the year. VAs lost ground, and we expect that to continue, mainly because of DOL-related issues. And indexed did not grow as quickly as it had been, but overall fixed did surprisingly well. This slide really talks about, it's the essence of what I really want to chat with you about today. It is disruption. Everybody's talking about it, right? Carriers are worried. Who's going to come in? What's the new model? And we don't want to be caught behind the 8 ball. But you have to take a step back. What we know from 100 years of research is that, in fact, the two biggest drivers of how insurance markets grow is really regulation and demographics. So the growth you saw of life insurance, the growth we've seen in annuities, was very much the boomers coming through, and as they came along and had families, they bought life insurance. As they had to save for retirement, they bought annuities. So demographics is key, and you always have to think about it. Regulation, really things like the IRA rules created tremendous opportunity. 401k created opportunities for carriers. So today, unfortunately, we often think regulation, sorry regulators, and the carriers go, oh, impediment. In fact, when you look at history, often they were the driver of what created bigger opportunities. What's different today are these two bottom things you see coming up. That's what's really creating the disruption piece, mostly driven by technology. But it's more than that because the consumer is changing. We're going to talk more about that change in the consumer, but their expectations, what they want at this point in their lives, wherever that is distinctly different than what it had been. So these, in my view, are what's driving the disruption. Now, when we ask CEOs across a variety of industries what they are most concerned about, overregulation makes the list as almost number one in every industry. But what you actually see is that insurance, it's the highest, 67%. That's their concern. So it is an issue, and DOL is an issue in particular. So everybody wants to know or debate what's going to happen with DOL. And my answer in the simplest terms is this slide. You simply can't get that toothpaste back in the tube. It may come out slightly different, but those who think it's just going to go away, I understand hope springs eternal, but don't get your hopes up. Why? Even if it went away, fundamentally, in the court of higher opinion, in the mind of that consumer, they've heard about this. Best interest is now in their vocabulary and in their mind. It is the standard that advisors will be held to at the consumer level, certainly at the high end of the market. But it's more than that. For those who thought the new administration was going to make a difference, I always remind people, there are 4,000 appointees. There are over 4 million government employees. Guess what? They haven't changed. The folks that our folks at the companies are talking to in DOL are the same people who wrote it the first time. I understand there can be directional differences, but at the core, it's not going away. On the other side, there are those critics who are the same. They always wanted DOL, they wanted a fiduciary rule, and they're still there. And certainly Elizabeth Warren is perhaps one of the most outspoken critics. When you look at the newest language that is in what they are currently writing, it still says you better change your comp structures and monitor sales practices of individuals. Same words. And they're still talking about the fact that there is conflicted advice. And no matter how you slice it, if there's commissions involved, by definition, there you get to conflicted. So I, for one, don't think it's going to all go away. In fact, there are many other trends, however, that we have to think about that are not DOL related, that are highly correlated. The recruiting gap. Those people who say, I'm going to spend a fair amount of my time selling insurance and risk products. There's a decline in the number of those folks being recruited. But the upper line is the growth in the U.S. economy. In the U.S. population. So not only are we having less feet on the street, the population is growing and we should be increasing, and that's just not going to happen. When you look at advice in general for retirement, stockbrokers and others, the projections of how much they will decline in the next decade is even more precipitous. So no matter how you slice it, there are going to be less people giving advice, less people trying to help people come to good decisions. At the same time, we've seen a consistent trend that the RIA community is increasing. So in fact, this predates DOL, but the trend is clearly there. Here's another trend. Index funds in 2016 had $492 billion in inflows. Actively managed funds, $204 billion of outflows. The market has spoken. Regardless of DOL, people are looking for lower priced alternatives. Whether that's right or wrong, that's not the issue. That's what's happening. When you look at Vanguard's inflows are equal to their next 19 competitors. The market has spoken. So margin compression is a reality, and that certainly is going to impact not only the mutual fund industry, but spread across through the annuity side as well. So my conclusion, you just can't turn back the hands of time. The trends are reasonably clear, in my view, regardless of what DOL does. Now, I talk about something that I call the age dichotomy. Remember, I said demographics are key. At one end, you've got the millennials, huge demographic group. At the other end, you've got the boomers, huge. You see, I kind of got Gen X there. Sorry to the Gen Xers. Nobody wants to talk about the Gen Xers because these other two sides are so massive. The boomers have pretty much created society in their own image, the way they wanted. It was good to be a boomer. Boomers, was it pretty good? But guess what? That was yesterday, and we're old news. Millennials are the ones that are reshaping the world today in their image. And that certainly includes things about sharing. And that is part of how they are forcing a change for all of us. And they're going to drive less cars. Think of the implications of that to insurance, to the economy, but it just is. So folks like Ford, both in the US and in Europe, are starting to say we have to change our business model. Millennials want to pay for what they need when they need it. There is really huge implications to that. Things like insurance. I want to insure it when I'm going to drive it, not all the time. And we'll talk more about that later. But the idea where boomers sort of wanted one policy and pay, millennials, not so much, right? I can see a couple of you in the audience nodding. So this demographic shift really is going to have real implications. The other thing people like me to talk about is what's distribution of the future look like. If that reality is that the number of producers is going down, what really does the future look like for distribution? We could spend an hour on this slide, we won't, but there are a couple of points I want to make. At the bottom you see DIY. What a lot of people believe is, I want it easy. I want to do it online. And certainly as we talk about fintech and insurtech, there's a lot of people trying to figure out how to make that happen. But guess what? It isn't gonna change everything. Human nature tells us, behavioral science tells us, a lot of people, remember I said they're gonna buy, but they don't. So a lot of folks start out DIY, but what our research says, they get somewhere waylaid. I get confused, too many choices. So many salespeople will say they procrastinate. Procrastination is an outcome of I don't know what the right solution is for me, therefore I will do nothing. But ultimately, many will start DIY, as you'll see in a moment, more are, but the fact is that's not going to be enough. So yes, there will still be commission-based and fee-only advisors, and I put commission-based as long as the regulatory regime allows that. And I say that because bear in mind that in the last 2 years, 3 countries have banned commissions: Australia, the UK, and the Netherlands. and there's 3 or 4 others that previously had. So again, trends globally are beginning to say conflicted advice, and we're going to do something about it. Don't happen to be an advocate of that, but there's some reasons which we won't talk about, but, well, we will. How's this? Because all the data says people need help, they need a push, without people to do that, I'm not sure that we're going to solve the retirement crisis. I'm not sure we're going to get more people to buy life insurance. We aren't winning the war now with them. I don't know how we win it without them. But what I want you to see, and it'll be hard to see, is in the middle, it says contact centers and virtual advice. People still want help, but they may not want it the way they used to get it. And that's what we're going to talk about. How else might they get some help? Well, robo-advice is what everybody's talking about. Now, when you look at just assets, Vanguard really is the big dog. But time out. Think about how many deals you read about in the last 15, 18 months in M&A about robo-advice. Everybody wants to be in it. But yet, as a percentage of total U.S. assets and how it's being used, it's not very big. But it's gonna be. And everybody's getting involved because they know that's what's coming. But this is some Northwestern Mutual data, and what it really says is half the people say, but time out. What I want is a combination. I want that, but I want some human intervention or some other intervention too. 33% say, I still want human. A recent study, 68% of emerging wealthy and high net worth said, yeah, I want that robo, but I too want some assistance. And so now I've never seen anything happen this fast, but suddenly everybody is getting in the, what I call a mixed model. Schwab really is changing the game, down to $25,000 minimum balances, and you can have robo and some human advice. So they're really looking to get into the game, but they're really saying we need both. At the same time, Raymond James is providing robo availability to their advisors' clients. So on one hand, we have the go direct. On the other, we have the advice model. Both of them are saying we need to provide both. And this one I find fascinating. This proves to some degree, I say, my basic contention that people still want people. Betterment was supposed to basically be the answer for millennials. You don't need any of those human advisors. You can do it all by yourself. Now suddenly, even they're giving human advice on their model. And so is LearnVest, by the way. Where do I think it's going? Here's Marstone, which is a new platform, again aimed at making advisors have the, I'll call it Watson-like, to help them. Now, whether producers are going to think they need Watson is a whole nother issue. But this is where I believe it's going. And I want you to think about this. I want you to think about Watson working with you. Watson can import, I just heard I'm sorry, ladies, I'm told Watson is a he. He can read 20,000 documents in like 3 minutes and retain it. I don't know a lot of humans that can do that. I am not one of them. But they can import data, real data about where that person's assets are in real time. Watson can then assume certain proclivities of that person from that data. and then make recommendations by actually speaking. Pretty scary, pretty intense, but the amount of knowledge that Watson has on markets, can have on that individual in real time, gives them an edge that no single advisor ever could. But when I said advisors really shouldn't go away, I use this slide every time I speak. Basically, contrary to popular belief, millennials tell us, 42% of them, I still want some help, some human interaction, face-to-face, which doesn't mean face-to-face the way we might mean it, but they want that help when it comes to life insurance. When we ask them the same questions about other financial transactions and savings, much higher than you'd think, that I want still some human help. Now, my contention is some of that is just someone to say, yes, this is right, I get it. And that's why I say I think even a Watson can give some of that positive reinforcement. Good news, consumers' opinions of both the knowledge and the trustworthiness of insurance agents is getting better. So I know the commissioners in the room will be glad to hear that. But we keep doing advice to try to say, does what advisors do matter? And one of the arguments against DOL was that fundamentally the lower mid-level income people would be left behind. So the latest research, and this is just out, that we did, pre-retirees with under $500,000 of assets who had an advisor, 15% of them felt they were well prepared for retirement. If they had an advisor, that number doubled to 30%. By the way, it doesn't mean they were right or that they had enough, but felt like they had a plan, they knew what was going on. We also know that where there is a written plan, that dramatically increases the proclivity to save and the feeling of I'm on a right track. Now, when I said humans still have a role, here's another example of a term site. If you remember, when these term sites were set up, their predominant purpose was to say, you don't need an advisor. I know you don't really want to deal with those people, yet now almost everyone has added a 1-800 number where you can get an advisor, or they'll match you up with one online. Why? Because they weren't getting the people to go all the way. They knew how many started shopping and how many never got through. But all of this, I think Sam Clements said, well, when you talk about is a producer, advisor, life insurance person, I think the report of their death has been greatly over-exaggerated. But that's in the short run. Because remember, I'm still saying Watson's going to get better. There's going to be other methods. But in the midterm, they're still needed and serve a purpose. And by the way, we can even ask Alexa, find me an insurance agent. Find me an agent that can help me on my auto or my homeowner. But I also got to give you the other end of this. At the same time, our data is showing a consistent increase in the number of people buying direct. And, you know, it's gone from 16% in 1998 to nearly a third, 29%. And we expect the next 5 years you're going to see a big jump. But it's still pretty gradual. These insurtech, fintechs, that's going to make a difference because we're going to make it easier. Excuse me. What our data says people really want, though, is omni-channel. I want to buy it, how I want it, when I want it, Is that 2 in the morning? You better have a contact center that I can get in touch with. You should have something that will help me fulfill online. And that's certainly for the life insurance industry not been the way the models have worked. Certainly some of the multi-line auto carriers have gotten far, far better at it. But if you don't believe that that is what people want, I found this the most fascinating thing. Amazon, the absolute top of the mountain of direct-to-consumer, is now opening up brick-and-mortar bookshops. Can you imagine? Who could have foreseen that? So even they believe some of this human interaction is needed to support their core model. Now, some of the things we have to do different if we're going to really capture particularly the millennials on that dichotomy. We have to enable 2 things in what I'm going to talk about: behavioral science and technology. So I know that Jason's here from Mind Blown, and that's not why I'm using this. I use it anyway. What we have to do is use more gamification. We have to make it fun, because we are not going to teach millennials how to save, how to think about retirement by just throwing a bunch of the kind of stuff, frankly, that we've created for 30 years, which we call collateral material. It's just going to go in the garbage. But Mind Blown is working to really turn it into games. Games that could help teach millennials how to save better. And I'll give you an example. USAA has a tremendous app. And their app actually doesn't teach in the traditional way someone to budget. But on their iPhone, they keep records of what they bought. And if you want that pair of shoes that's not in your budget, then you got to save money. And to do that, every time you don't have a Starbucks in the morning, you get to take a credit. That's the way you can help teach. But through things like Mind Blown, that's how we have to get mind share to teach them their way. And you're seeing others like Wells Fargo put some learning. This one is not as gamified as where Jason and his team are going. But what you do see is big companies beginning to adopt these approaches. But this is also really getting at things for all of us to really think about the importance of auto-enrollment. We know what a huge difference the first year it makes where people are auto-enrolled and have to opt out. By the same token, even after 2 years, there's a 25% pickup. And that's simply using behavioral economics and people's kind of, I'll leave it the way it is mentality to help them help themselves. And by the way, when you look at Europe, and some of the data is old, organ donation, the US is down here. Many of the European countries are up around 98%. You know why? Opt out. It's automatically presumed in most of those countries you're given it, you got to opt out. So I think we're going to have to be thinking more about how to help people make better decisions through what we know works with behavioral science. Another way of doing that, many of you have probably bought something on Amazon you didn't plan on. In fact, 1/3 of all their sales is their recommendations to you. 1/3. But guess what? That's behavioral science. They just took an idea and they figured out a way to put it online. Now, we recently did some studies of our own around that, and we found that this social norming wording actually more motivated people than anything else to buy life insurance. And we have some very specific data. I'm not going to get into that today. But in fact, saying people like you have about 500,000 suddenly was a great way to get people to act. And we got to get more people to act. This was some joint research we did with Maria's firm, Maddox Douglas and LIMRA. We figure there's 18,700,000 stuck shoppers. They started shopping for life insurance. They just didn't finish. That's when I said they get stuck, and we've got to find out how to make it easier. Now, what our data tells us is part of the problem is not simple enough, too complicated, takes too long. You use words that I don't understand. That's a real problem. But I'm going to tell you something. I did a little trick on all of you. If you could see really small print, lower left-hand corner, this is a slide we used in 2005. We haven't advanced much as an industry in over a decade. And in fairness, it's getting harder because there's more and more disclosure, which is the way of the world. That is a total turnoff to those millennials we want to sell more to. So I think there's a huge conundrum for the regulators. How do we protect consumers adequately, but the consumers also want it to be simpler like everything else they buy? It's a dilemma. Now, 86% of CEOs say technology is totally gonna change our business. Those aren't just insurance, that's globally all CEOs. So we're not alone. And in fact, I think if anything, most of us know we're sort of behind a lot of industries. So what are some of the things that people are talking about? They're not proven yet, but I think it gives you an idea of what's going on out there. First of all, an app that can determine your mood from your voice. I need that with my wife. If they can get that into my iPhone, I'm buying it. But this is, is it good science or isn't it? But your contact center people might know how to be more responsive. They might know when there was a better cross-selling opportunity. So there's lots of ways that we might be seeing this in the future. But others are trying to build engagement in new ways, and I heard that a little this morning. Most of us, the only communication our clients got from us during the year was their bill and maybe an annual statement on a life insurance policy or a quarterly statement on our variable annuity. Those can be good things or bad things, right? But we didn't really create any relationship. So this is a firm, Life.io, that is really working on how to build a relationship and getting folks to want to come back to your site and have a relationship with their carrier. What they're doing is pretty effective. On average, they bring 7 other of their friends to that carrier's site, which is pretty significant. Now there's a better opportunity for them to cross-sell that person, but also to maybe make friends with their friends. This is not something we've been very good at. Others are looking at AI, and I certainly heard that this morning on the regulatory panel, and that's going to pose a lot of questions. So these are just some of the things that technology could really be a game changer. But let's talk again about the age dichotomy. But this time, let's go to the other end, to people who look more like me. One would think that boomers know a lot about what boomers are going to do in retirement. But the fact is, we have no clue. And any research we have is literally changing every day. But you're going to see why I think as big a deal it is with the millennials, this is as big or bigger deal when it comes to our industry. And we're not thinking much about it. Let me show you why, and I'll try to read these numbers because they're really important. Right now in 2014, there are 48.6, so get that in your head, 48.6 million retirees. By the year 2025, that's 66.4 million. And by 2040, it's 82.1. Never in the history of our country have you had that many people in retirement. Now, when you start to think about the implications of that and the fact that they are much liable to live longer than any retiree in history, and with all those questions that were raised this morning about health care, this is really a big deal, and it's not getting enough attention. But it's also important for another reason. Today, boomers and retirees have 84% of the total investable assets. What happens when they're all in retirement? How will they invest? How will it be different? How will they draw it down? I know we have a great answer with annuities, but the fact is very few today have that included in their exit strategy. These are really big issues, folks, and ones that aren't getting enough attention. At the same time, what are they going to want us to insure? We know that they care a lot about long-term care, but look what's happened to long-term care insurance sales. Now, there's two problems there. What we were selling wasn't really affordable, and carriers were losing a lot of money. Certainly, the regulators weren't happy with all the phone calls they were getting about it. So it was a real dilemma. But guess what? We're a little bit on this one like a turtle going into its shell. All the industry's done is predominantly taken out most of the coverage available, but guess what? There isn't much that's come back that's going to help solve the problem. Now, I kind of congratulate Bankers. They've got a new coverage that's kind of keying into Alzheimer's. This isn't meant to be some massive type of coverage that's going to solve LTC, but it's kind of like a critical illness. It's going to key in to a concern. We are going to have to look for incremental solutions, not the one is going to just solve it all, because I don't think that train's coming back. The one other thing that our data suggests pretty strongly, people are much more worried in their 50s about Alzheimer's at about a rate twice their fear of cancer. Pretty remarkable when you think about it. Now, I have a theory. We also, by the way, see in the data a real uptick in interest and concern about long-term care. But a lot of boomers are taking care of mom and dad, right? Or dealing with those issues. So we really are seeing a spike because now it's coming home closer to them. But this is an issue that we got to start thinking about. But for me, it really has a broader implication. I said these consumers are different today. How they're going to view and want to buy insurance is going to be dramatically different. And as the commissioner panel rightly suggested, this is coming quick, fast, and the ability to keep up is going to be a real challenge for them and, frankly, for the carriers who have not gone through remarkable change quickly historically. But my question is even more fundamental. What risks are people really going to care about? What are they going to want to insure? And especially all that money sitting with retirees, guess what? They're probably not buying life insurance. I know they're not buying DI. We've already said they want to buy LTC, but nobody wants to sell it to them. So what are we doing for them? And what we are seeing is a trend. We saw it earlier in Europe. We saw it earlier in Canada, is what I call this high perceived value, low cost alternative. How many of you remember getting on an airplane and buying a policy for that one trip at the kiosk? Or at least remember it existed. People were really afraid of flying in the early days, right? So now the cost was absurd. It really was. I mean, you could have bought AD&D for a year at a third of the price of what they were charging you for 4 hours. I'm not saying it was good value, but people have a fear. That's the itch they want scratched. So we are seeing people say, boy, 41% of consumers age 50 would pay for exploitation prevention insurance. That's just not one we've seen a lot of, right? But that's what they're saying I care about. We're certainly seeing a real tremendous growth in non-traditional benefits. So that goes across from accident to critical illness on the voluntary basis. But critical illness sales in the U.S. have been trending upward. Now, some think this is bad, that people may not fully understand what it covers. But more and more folks are saying, I can afford $1.62. I'd rather have some coverage than none. And again, in Europe, in Canada, much earlier than here, we saw these trends. But now we have millennials who want to insure their bike online and in about 4 minutes. Gee, can't quite get my property covered in my apartment in 4 minutes online. But that's what they're worried about. But we're also seeing that Allstate just paid $1.4 billion, basically for a company that extends certain kinds of warranties and covers what millennials care about. Their iPad, their iPhone, right? At the same time, we're seeing new insurance models that you can insure your bike, your guitar, your TV, what you want, when you want it. And not for a year. I'm going on a trip and I'm really worried about it. I want it now. Different world. And we even see event insurance. Progressive just actually did a deal and is working with them. So, you know, it's a whole new world, and we can even insure our drones online quickly. Who'd have thunk it? But I think this is best categorized by what Bill Gates suggests. People way overestimate how much change will really happen in the next 5 years. But we way underestimate what really happens over a decade. And I think that's where we are. A lot of those insurtech and fintech things are going to change. But sort of reminds me of 2000. A lot of them will go down in flames and not be the perfect solution. Trying to figure out which ones are the winners and losers. It's going to be hard for regulators, hard for carriers, but we gotta, because if we can't deliver what it is that we sell, if we can't get people to make better decisions by helping them the way they want to be helped, we're going to keep seeing numbers we don't like for retirement savings being too low, how many households own life insurance being too low. Because guess what? Those aren't going to the top of the list for most. With that, I'll just open it up to a couple of quick questions if there are any. With or without a mic, I can hear you. Anyone?
Oh,
right here?
go ahead.
Thank you for breaking the ice. I know it's hard.
Okay, it's me, Bob. Several slides back, you had something that showed the improvement in the perception of advice or the advisor, like the perceived value or the trust, I think it was.
Trust and knowledge.
Trust and knowledge. That's great. Do you have any more insight as to what was driving that from a previous decline?
Let me actually answer it slightly differently. I don't have that insight. But one of the things we've found for years in the research, people say, generally, I don't trust salespeople. I don't trust insurance salespeople. But then when we ask a follow-up question about do they have one, and they say yes, like 70s, 80s, high trust. So there's sort of this, I don't trust them in general, but I really love mine. So we've always seen a dichotomy in the numbers. I mean, I think if you think about it logically, advisors gave people advice that in the downturn did not seem to be perfect. So you would have expected in the downturn that there could be some decline. I said earlier that written plans matter. Where people had written plans, I wish we could get the data to prove this. 43 years tells me it's true, and watching 3 downturns, people who had advisors did not dump their portfolio at the high percentages that the other people panicked at the wrong time. So one of the things everybody focuses in on is how high the fees are for advice. And my own belief is what no one has ever captured for data is what percent of those people that had an advisor didn't jump off the ship when we were at 5,000 or 6,000, and just because their advisor said, stay the course. Don't do the stupid thing. And see, I see some of you nodding. Some of you had advisors just said, just stay the course. Those people clearly not only didn't lose, came back higher than where they were. But you know, most people buy high and sell low, and that's a problem. So I can't tell you other than I think the downturn played into when you look at the numbers. We have one more? Anyone? Well, thank you very much. I'm going to let you get back to lunch. Thank you.
Thank you, Bob. Yes, we're happy to hear. Happy to hear there's room for humans in the life insurance industry. I think yesterday we heard that the factories are going to be run by a man and his dog, and the dog was there to keep the guy off the equipment. So there's room, high school students, in finance and insurance. Keep that up. Thank you. We start again at 2 o'clock upstairs. See you there.